Debt market update, November 2022. GSEC yields moved within a range during November 2022 in the first half, but declined in the second half. 10-year GSEC yield ended 17 basis points lower at 7.28%. However, the short-end yields rose slightly, thus further flattening the curve. The movement in yields was driven by easing of CPI in India, lower than expected US CPI, fall in oil prices, likelihood of moderation in pace of rate hikes by US Fed, drop in US yields, etc. Corporate bond spreads over GSEC were largely steady vis-a-vis last month. Average net interbank liquidity improved month on month, driven by drawdown of government cash balances and purchase of US dollar by RBI due to improvement in equity FPI flows. However, the robust credit growth weighed on the liquidity. FPI's market activities remained muted, and net outflow from debt was $0.3 billion in November 2022. Cumulatively, FPIs have sold debt worth $0.3 billion in 8 months FY23, vis-a-vis being net buyer of $4.6 billion during the same period last year. On December 7, 2022, RBI's Monetary Policy Committee raised the policy repo rate by 35 basis points to 6.25%, with a majority of 5-1. The MPC also kept its stance unchanged and reiterated that it remains focused on withdrawal of accommodation to ensure that inflation remains within the target going forward, while supporting growth. To recap, since the beginning of tightening cycle in May 2022, RBI has raised the repo rate by 225 basis points, including the aforesaid hike. Outlook: the hike in repo rate along with RBI governor's statement were largely in line with market expectations. However, unchanged stance and tone of RBI governor's statement was perceived hawkish, and usage of words like break core inflation persistence, battle against inflation is not over, etc. indicated that more rate hikes may be in the offing. Additionally, the retention of MPC stance and governor's statement that market participants must wean themselves away from the overhang of liquidity surpluses, and RBI likely to intervene if it sees durable signs of turn in liquidity cycle, were construed as RBI is likely to allow liquidity to shrink in the near term. In reaction, yields rose across the curve, with yields at short end rising more than the long end. Governor, however, reiterated that future course of action is likely to be data dependent, nimble, and in the best interest of the economy, while keeping growth in mind. Over the past few months, the Indian 10-year GSEC yield has moved within a narrow range, despite significant movements seen in global bond yields, increase in domestic policy rates, and rise in external sector risk weighing on INR. Majority of these factors have started to ease and are likely to continue moderating going forward. Expectations of US FOMC likely to reduce pace of rate hikes, lower than expected US CPI, and easing growth indicators have resulted in US yields and DXY falling. Broad-based correction in international commodity prices from their peak and easing supply chain should moderate inflationary pressures. Low risk of fiscal slippages and increasing consensus that repo rate is not far from the peak, in view of growth inflation dynamic, bodes well for the yields. Although tight liquidity and strong credit growth can keep yields at short end elevated. On the flip side, elevated inflation, especially core CPI, high inflation expectations, resilient domestic growth, and continued global monetary tightening are likely to keep yields at elevated levels. Further, while input prices have eased, it is yet to reflect in consumer prices and is likely to reflect with a lag. Heightened geopolitical risks and elevated oil prices are also likely to be important considerations for domestic policy rates and thus should have a bearing on yields. Supply of state development loans has increased in recent weeks and is likely to rise further as the state spending picks up. This, along with high SLR holdings of banks and robust credit demand, could also push or keep yields high. On an overall basis, given the counterbalancing forces at play, yields are likely to trade in a narrow range in our view. In view of the above, we recommend staggered investments into short to medium duration debt funds, with some allocation to longer duration debt funds in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.